So, Australia's major banks have just ruled off FY24, and we're here to do some number crunching and give you a summary of those results. Cash earnings for the year were $30.7 billion, and that's a reduction of about 5.5% on the near record year in FY23 of $32.4 billion. Return on equity was 11.1%, a near enough 80 basis point reduction on the prior year. Now, despite this being a near record result, it also shows that competition and costs pulled back the rate hike record of the FY23 returns. So let's break those down. On competition first. Net interest margin fell by approximately 6 basis points year on year, though there was a small uptick in the second half. It really shows the fading of the rate hike benefit that has been achieved over the last 2 to 2.5 years. And to put that into context, margins at 1.81% are now around about 5 basis points higher than the low that we saw just before the rate hike cycle, and about 8 basis points or 9 basis points lower than the peak that was achieved in first half 23. Balance sheet growth didn't quite offset the reduction in margin. The majors' lending balances grew by about 3.5% for the year. And while that's a slower rate of growth on the prior year, there was also a stronger rate of growth in the second half of FY24. Positively, business lending continues to be a real driver of credit growth. So for the system, 7.5% growth in business lending. And for the majors, they actually increased market share in business lending, which helped to offset some of the declines in share for mortgage lending overall. The next big topic was costs. Operating expenses grew by over 6.5% for the year to a record $43.2 billion. And the cost-to-income ratio for the industry, or for the majors, was 48%, an increase of over 300 basis points year on year. That represents the highest cost-to-income ratio, excluding notables, for over 10 years for the major banks. And it's quite significant to really think about the tension that represents in terms of the investment requirement that the banks have for technology, for regulation, and for increasingly optimizing their businesses at the same time as trying to deliver short to medium term returns. And to put that into context, a target that people used to talk about a lot was a 40% cost to income ratio. Everything else held equal today, to hit 40%, the majors would need to reduce costs by near enough 17%, or just over $6 billion. Finally, on credit losses. Well, credit losses actually have continued to really support the results. So for this year, credit expense actually fell to $2.2 billion. And while all the majors did call out some spiking in arrears and single name exposures, it doesn't appear to be significant at this point, and it was really characterized as what we would expect given the point we are in the economic cycle.